Hello and welcome to the Power of Passive Investing webinar series. We have an amazing guest today, Jeremy Roll. He's actually been in our webinars in the past and he's back by popular demand, of course. Now that the elections are behind us and 2025 is around the corner, we have a very popular topic to uncover and unpack, and that's what we're going to be doing. But anyway, welcome, Jeremy. Good to have
Thank
you.
you. Thanks for having me back. I really appreciate it. Thanks for everyone who's listening and taking the time. This is the first podcast I've been on since the elections in 2024, so it's very interesting.
Perfect. So that's good. Jeremy, for our audience, for those that may have not heard your first interview, maybe give us a 2-minute bio on who you are and what you do.
Sure. So my name's Jeremy Roll. I am originally from Montreal, Canada. Moved to the U.S. back in 1998, so it's been many years now. And I live out on the West Coast near Newport Beach in California. I basically have an MBA from the Wharton School, spent over 10 years in the corporate world at some very big companies, including my last one was Toyota headquarters here in Los Angeles, Disney headquarters. I worked at GM headquarters. But the bottom line is I started investing in kind of alternative opportunities, mostly real estate related, that were all passive back in 2002. So it's been 22 years. And the cash flow had got me out of the corporate world back in 2007. So that's been 17 years. And so I've been a full-time passive cash flow investor for 17 years, but been investing in these types of opportunities for over 22 years. And I do this full time. I pay a lot of attention to the economy because I try to really avoid the landmines by trying to predict what may be coming up in several years, 5 to 10 year timeline. I'm sure we're going to get into a lot of interesting topics around that today. What else? I'm very highly diversified. I'm currently in over 60 LLCs, currently actively. I've been in over 150 to 200 over the past 20 plus years. So I'm a very big fan of tenant diversification and opportunity diversification. I'll leave it at that.
Thank you, Jeremy. Yeah, you actually live and prove that one can live on a cash flow and can become completely passive and retire early, because many people still struggle with that concept and don't really understand that it is very possible. And thank you for bringing it up. And I'm personally also a big believer in diversification and diversifying out of Wall Street into Main Street. And that's one of the topics that I've covered in my book that was published a couple of months ago, Your Legacy on Main Street, where I talk a lot how one can not only invest in the stock market, but should also consider other investments such as private placements, businesses, gold, oil, and so forth and whatnot. So the goal is to diversify, to have a well-balanced portfolio so that with the next stock market crash, you don't have to worry, and you can sleep better at night and continue with your investing. So with that in mind, I'd like us to start kind of at the point where we are today. The election is behind us. Politics aside, we're talking real estate here only. From a real estate standpoint, now that we know that Republicans took over presidency, the House and the Congress and so forth, what do you see the implications are, given what you know about past elections and having Republicans in the House and knowing that in this case it's Trump? What are your expectations?
Yeah, great question. So before I start this answer, I just want to tell everybody two important things. First of all, I don't vote, and I can, but I don't. I'm just fed up with politicians. So for me, it's all about, I don't really pay that much attention to it, but I do pay attention to it from an economic perspective. So I very closely pay attention to an economic perspective. And number two, just, I'm not a financial advisor, investment advisor, accountant, or attorney or anything. So anything I'm sharing today, just my perspective as an investor. Yeah, it's a very interesting topic, and we can get into a lot of different paths on this, I'm sure. But bottom line is that it seems like the consensus, as well as a 10-year treasury reflecting it in interest rates, is that Trump being elected is going to be more inflationary potentially than if Harris would have been elected. And I actually think that it would have been inflationary regardless, but we'll never know for sure either way. I do think that Trump will probably have some tariffs and other things that will make things a little bit more inflationary, but I suspect, kind of like the last time he was in office, that some of the things he said he probably won't do, or he won't do to the degree that which he said. And so if that holds true again, then I do expect us to have probably a relatively inflationary, 4 to 10 years, honestly, which I think would have happened regardless of whether he was in or not. I expect a lot more money printing. I expect now we're just talking about from him being elected specifically. We can get into
Yes.
2025 and everything else, but I do expect some inflationary stuff. I expect from an investor perspective, more tax favorable environment. I expect a more accelerated depreciation favorable environment, which is very helpful for a lot of the things that I invest in. We could see some tax cuts that could impact investing and long-term capital gains, et cetera, or recapture rates. So there's a lot to watch still. Honestly, we're not sure yet. So I think that we'll probably know within the first 100 days really what's going to happen with a lot of those things, because I think a lot of them are priorities from Trump's perspective. They were last time, and I think he's made it clear they're priorities again. So we won't have too long to wait to see what happens, but I expect most of it to be positive from an investor perspective. Now, I want to be clear. That does not mean, in my opinion, that we can automatically avoid a recession that may be coming up, that just because Trump's in that he could just fix all problems. In my opinion, and looking at history, that's just not true. It's not factual. So, I always try to look at the data and try to extrapolate from the past to help predict the future. And I just want to warn everybody today that if you're out there and you haven't done the research and you think that because Trump will be inflationary and print a lot of money, et cetera, that it's impossible or unlikely we're going to have a recession, you should really go look at the data. I mean, there are some key times where, just after a president was elected, especially in inflationary time, boom, we have a recession right after, because rates have already been high for a long time and they have a delayed impact. So we're just now feeling the impact of that just recently. And we're going to get into some more of this, I suppose, but just don't be fooled by that specifically. It's not something that can just be automatically avoided because someone got elected.
For sure. And as for any president, Trump has a lot of work in front of him, and that work is not going to translate into results overnight. It's going to take several years, maybe all 4 of his years in the White House, for us to see the results of his presidency. So it's definitely going to be a very slow-moving process. Agree with you on that. I wanted kind of to touch upon what you mentioned earlier, the fact that you personally believe in, obviously we know it's only your opinion, it's not any sort of prediction, why the environment would remain inflationary regardless of who is in the White House.
Yeah, so my big fear about the inflation side of things is that the Fed and frankly the US government are trapped. And what I mean by that is that, I don't know if whoever's listening to this has watched the data, but the CPI actually increased to 2.6%, and that was released earlier this week. But yet Jerome Powell completely brushed it off in his comments and just said, oh, it can go up and go down a little, but the trend is down, right? And so the challenge we have, and by the way, core CPI, I think is over 3%, and which is very high still. So, but where we're stuck and where the Fed has a big challenge is that the amount of debt that the banks took on in the past few years that have generated losses because they issued and hold paper written at 2%, whereas the current rates are much higher, so the value is much lower, along with the fact that it highly benefits the government to be able to issue more debt because it's issuing so much debt at lower rates. I personally believe that the Fed is going to be under pressure to continue to drop rates regardless of where inflation is, unless inflation gets completely out of control and it's kind of obvious, right? So I think what I'm trying to say is that the Fed is going to be biased towards bringing interest rates down. And by doing so, you're basically doing the exact opposite you would want to be doing theoretically if you were trying to fight inflation, okay? And so the last mile on inflation is always difficult, and that's actually what we're going through right now. But I do feel like the Fed cannot be reactive to help reduce inflation, in my opinion, and it's going to be biased towards reducing the rates. So that actually will be good, probably from an investor perspective, but it may not quite be as good from an inflationary perspective, which kind of then has domino effects for other things.
Sure, and thank you for your explanation, Jeremy. A lot of it makes sense, and time will only tell as to where we're going with the new president in the House. Now, in terms of real estate, we've been going, real estate is always cyclical, as we know, and overall, in general, real estate has been going through some down cycles. Now, as we entering a new era, a new phase, and again, new president, how do you think that will impact what real estate is going through? And if you believe there is a difference between residential and commercial, feel free to spend more time on one or the other, as our listeners are interested in both.
Yeah, sure. So I'll split into two because I do think they're completely bifurcated and behave differently. So on the commercial side, which includes multifamily and all other those types of income generating asset classes, I think that we've experienced one of two dominoes that have fallen. Interest rate increases are domino number one. We all know those have happened. That's a fact, and that has impacted and actually caused a crash in commercial real estate prices. And I like using the word crash because nobody else is using it, but it's a fact because prices are down 20 to 35% in most major asset classes. A crash typically being defined as over 10%, and some people say over 20%, right? So we've had a crash in prices, right? And but the challenge, in my opinion, is that on the commercial side, is that I think we're still waiting for the second domino to fall for a full, proper end of cycle reset, which is actually end of cycle, meaning a recession. And for many reasons, which we can get into if you want, I still believe a lot of indicators are still showing that the base case, the high probability case, is a recession. Of course, there may not be one, but to me, that's the base case that I have in my head, and it's keeping me completely on the sidelines at the moment on the commercial real estate side with very few exceptions. Now, on the residential side, different story. We have a lot of people locked into 30-year fixed rate, lower rate loans than today. I'm sure everybody here probably knows that already. It's not news. And the best projections that I've seen that I agree with as far as what's going to happen with pricing is that because people are hesitant to move and supply has therefore been low on the sell side, that the most likely or most probable path we're going to take is to kind of go sideways, relatively speaking, or slightly down to be able to, for a whole number of years. And by the way, this is very markets, but some markets are already down, right?
Sure.
But I'm just saying nationally and generally speaking, probably go sideways or slightly down in the average market. And that will happen over a number of years, like 5 to 10 years, in which case, and that's already started, by the way, right? That started a couple of years ago. And that will allow incomes to actually increase while having the price of the home stay the same. So affordability is actually increasing now over the years, assuming the price even remains the same, right? So if you live in a community where prices are flat, the affordability is increasing because wages are going up every year, presumably, right? So the problem we have on the residential side, and it's very clear on charts, is that we have very low affordability in most places in the US with some exceptions. Yeah. And at the end of a cycle, the affordability resets and adjusts. That's what happens every time. And so this time it appears as though that won't be accomplished as much from price reductions as it will be from going sideways for a while for incomes to catch up to prices. And trust me when I tell you, I love a price crash because I'm waiting to buy a house for myself. You know, I rent a house right now, but I realistically just don't think that's going to happen. I think it's more likely it will go sideways for a while.
So that means you'll continue renting for a while as well.
Well, most likely. Yeah, I'm still, I'm going to take a look at what happens next year. If there is a recession, we'll see like, okay, is there a price decrease or not? My particular community is very specific. It has different dynamics, a lot of foreign investors and foreign buyers and foreign, users. So it's a little bit different. But generally speaking, that's what I would do on average.
Sure, yeah, that makes sense. Let's go back to the commercial real estate. In terms of the recession, you said that you see multiple indicators showing the signs of the recession. So let's dive into some of these indicators, if you will.
Yeah. So I have so many. I mean, we could spend way too much time on it, but let me just give you a few that I think are very compelling. So the first and one that I think most people aren't aware of, which I think is very important, is that when you take a look at historically, the average amount of time between when the Fed starts to increase rates and when a recession actually occurs as a result would actually lead us to July of 2024. So we're recording this in November 2024, which is only a few months past the average. So if you think that we've had a soft landing, we're completely out of any harm's way, I will tell you that factually speaking, that's not correct because we're just a couple months past the average amount of time a recession would have taken. The media did a great job of giving misinformation and making people believe that even in 2024 at the beginning or late 2023, that we had already, it had taken too long and there would have been a recession already. It's just not factually true. It's just not the way it works. And so this is why it's so important to kind of really look at the data when you're trying to figure out what's going on. In my opinion, one of the things that have led to this being above average timeline has been all the stimulus money that is finally now wound down. I think that has kind of created a longer timeline for the recession to unfold, but I do think the recession is still coming. And a couple of other important indicators to keep in mind. Right now, if you look at the Michigan consumer sentiment, which is the most popular one people look at, you will see that we are actually, if you put on a chart, we are actually at recessionary levels right now, meaning that in the past, if you looked at this piece of data on a chart and go back, every time we're at this level, we're in a recession. So I'm not saying we're in a recession today. I actually don't know because eventually the data will be revised. But the point is that sentiment is very low and lines up with there being a recession now or on the short term. Okay. We had an inverted yield curve. That's now uninverted. Okay. Once you get the full uninversion, it's not fully uninverted, but once the 3-month and the 30-year uninvert, which happened within the past few weeks, that is the most the best indicator of a recession coming up relatively soon. It doesn't tell you exactly when, but typically within several months. Okay, so that's another thing to keep in mind because we had an inverted yield curve for a record long time, and so that's something to keep in mind. There's like the unemployment rate, the increase from 3.4 to 4.1%, completely brushed off by the media. But if you look at all past history, we actually have already hit with the pace at which it increased earlier this year. And now I know it's flattened a little bit, but it never goes up straight. If you look at it, it's the exact same thing every time. It kind of go up, down a little bit, and eventually goes up. We already would have triggered different rules that say that we're actually close to having a recession, one of which says we're already in a recession. Okay, just based off of the unemployment increase we've had already. And another indicator that's very, very important to watch, which I never see the media quote, is at the end of each cycle, what ends up happening is that people start losing their full-time jobs. And what do? They can't find a full-time job as easily. So they pick up part-time jobs, typically a couple, okay? Those part-time jobs, if somebody then loses their job, their part-time job, they're not counted as unemployed. The unemployment rate doesn't go up, okay? So we now have very high levels of part-time employment, which is exactly in line with directly at the end of a cycle where everything just starts to reset. So there is many different things that are kind of just not obvious unless you're going to look for this that aren't being discussed in the media. And I could keep going on, by the way, there's many other indicators too. So to me, we still have a very high probability of recession. And for those of you who have not done this, you'll be fascinated. Go Google Ben Bernanke, soft landing or no landing, and you will see that in 2007 and early 2008, he literally was quoted as saying that he had already achieved soft landing and it was done. And then we had the recession a little while later. So the term soft landing has come up a lot in the media in the past year and a half. It actually, if you do look at Google searches, it's about similar to the last recession. It happens every time. The term is used by the media and by the government to make people have the sentiment that things are better than they are. And that's just the way it works. But fact of the matter is that we rarely achieve a soft landing. It's actually much less probable to achieve a soft landing than a recession. So just that alone would make the more high probability scenario in this case, with everything I've told you, to be more likely to have a recession than not a recession. So I'm going to stop. I know I've said a lot.
Yeah, no, this was definitely a good overview, and thank you for providing a number of indicators that, from your standpoint, indicate the recessionary environment. Now let's take a little bit different approach, and let's talk about investing, since you've been an investor for over 2 decades, well, at this point, 2 decades. Given what you know and what you think is going to happen with the recessionary environment and so forth, from the investor standpoint, and granted, we're talking primarily about real estate, but feel free to talk about other alternatives as well, because we do cover other alternative investments here in our webinar series. Do you think the environment is plausible to invest, or is it still time to be more cautionary and kind of sit on the sidelines?
Yeah. So the challenge that I'm having, and why I'm really fully on the sidelines now with very few exceptions, which we'll get into, but is that I'm concerned. I mean, look, a recession on the real estate side, and especially on the commercial real estate side, leads to increased vacancies, reduced occupancies, expenses continue to go up, and then you have, what do you have of all that? Reduced net operating income. Even at the same multiple that someone's paying to purchase a building with a lower net operating income in the same multiple, the building's worth less. But then what happens in a typical recession is a stock market crash. And unfortunately, one of the pieces of data I didn't share is that we had a record long inverted yield curve. And actually there is a direct correlation between the length of the inversion of the yield curve typically and the actual percentage decrease in the stock market. And one of the reasons, which makes sense, is because the longer the yield curve is inverted, the longer it takes to get to the recession, the more the stock market's gone up. So I know this is going to sound crazy, and we're even saying it, but the charts are showing that we should have a 45 to 60% decrease in the stock market if we have a recession this time, just so you know, because of the lengthy inversion of the yield curve based off of that chart I told you. So if we have that or anything remotely close to that, we're going to have increased fear. We're going to have equity, which is an investor equity, limited partner equity, going to be much more difficult to raise. They're going to have debt. The banks are all going to seize up. They're going to have all kinds of distress. And so it's going to be harder to raise capital. And what's going to happen? The cap rates are most likely going to go up and the multiples are going to go down. Okay, because that's an end of cycle typical phenomenon. So now you're going to have lower NOIs and cap rates going up, and they have a compounding effect of actually a lower multiple on a lower net operating income. And so I am just waiting until all of that risk gets out of the system potentially, or we see that it doesn't happen, because I tend to be a low risk investor. And also I tend to invest in stuff that's kind of minor or no value add, not major value add. So I have to buy it at the right, very careful with that. And one exception is, which is not related to real estate, is if you take a look at what's happened with startups, it's actually pretty fascinating. Startups had a major reset in valuations a couple of years ago when the rates started to go up, and they just completely crashed, okay, in multiples and valuations. So what's happened is that we have had very low IPOs in 3 years going on, if we, in 10. And so we've already had 2-3 years of getting through all that. Now you have people who've gotten laid off from tech companies that happened in the past 12 months. So you have easier to hire people, cheaper labor, much lower valuations to invest in startups. If you take a look at startups, which I don't normally do personally, but I dabble in a little bit, now it would be actually a good time to invest in startups, in my opinion, depending on what you're investing in. Will it get through a recession? Okay, et cetera. Because of all those other factors, is very favorable. And it's very well known that a lot of really good startup investments happen either during a recession or just before recession because of all these things. So I feel like the startup world is kind of ahead and has already had its reset. And it's been very difficult to fundraise there for the past couple of years. Now, as far as other alternatives, we'd have to go alternative by alternative because they're all different, right? Because energy is one thing, gold is another thing, like they're all different. So I can't really comment macro on that. But the only other thing I've been personally investing in for a whole number of years while it's been this crazy end of cycle has been happening is I've been doing tax abated multifamily opportunities because they're a defensive play going into a recession and they provide a lot of positive leverage. Well, one of the biggest issues I have with what's going on in the markets today is that we have negative leverage still, or about neutral leverage, but not a lot of positive leverage that I think as an investor is what you need to compensate for the risk. And that's my number one guiding light as to like when I'm going to jump back in on the real estate side, on the commercial real estate side, is seeing a fair amount of positive leverage to basically commensurate with the risk.
Makes sense. And thank you for that overview, Jeremy. It's interesting that you mentioned startups. For someone who is more or less risk averse, I would think startups would be probably on the lower end of the list rather than the higher end of the list.
It's on the very low end of the list for me in general, and I don't invest in random ones. It's only when I have to make a bet on someone I know really well. It's got the right stage. I think there could be a big enough multiple valuation, all these different things, and I understand it well. But I'm just pointing it out because I do think that that's an interesting part of the cycle that someone could look at.
For sure, and thank you for that. And in terms of your suggestion and what you see in the market, the stock market may potentially crash by at least 40% or more. I actually read an interesting article a couple of weeks ago where Goldman predicts that we will have the stock market perform on average 3% a year, which pretty much is reflective of what you're saying.
Yeah, so right. So a lost decade, the way that happens, and that's probably what they're referring to, it's a very common term, happens when you have a crash, and then from that low it does go up, but eventually it just takes so long to get back to where you were even at the top that you're going to have a very low. So, and the reason why they say that, it's very simple. They're just looking at past data, seeing the returns people have had for the past 15 years, knowing it's completely out of off the charts, and therefore they're expecting it to normalize, right? And the most common way to normalize, that doesn't normalize just all of a sudden, it just goes by 3%. It normalizes through a crash and then trying to get back up to where it was before. So it's the same idea, same conclusion.
Yeah, we're definitely in time, we're very near the crash. No one can predict when that crash will happen, and it may still take several years to get to that point. However, it doesn't mean that we should be sitting on the sidelines, just taking different approach to our stock market investing overall.
I will tell you though that one thing I didn't mention is that based on all the recession indicators, I would expect a recession by, at the very latest, the fall of 2025. If we haven't gotten one by then, I'm going to reevaluate. But so if we were to have a crash, in my opinion, it would most likely be in 2025 from a stock market perspective. We'll have to see.
Yeah, time will tell. Well, thank you for that. Jeremy, this has been an incredible interview. A couple of last more personal questions that we ask our audience. If anyone in the audience would like to reach out and ask you follow-up questions, is there a way for them to reach out to you?
Yeah, absolutely. Yeah, the best way to reach me is through email. Anyone's welcome to reach out to me. My email is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Thank you. And our last question we always ask our interviewees, how do you like to give back? What do you do to give back to your community?
Yeah, that's a good question. So I do a lot of different things, actually. I'm lucky because I have some time to do it. So first thing is I've been on over 200 podcasts, and I literally just do these to help people. So anyone who stayed with us to the end, appreciate you staying on. I really hope it was helpful. That's kind of the whole point, right? So that's kind of number one. I have a lot of calls with people in general who are just trying to figure out the space, and just happy to give back the time and help people there. I do a fundraiser each year, for a specific cause, but I also donate to probably over 25 different causes each year. And so I just, I try to help in various ways.
Thank you. And I can personally attest, guys, that Jeremy does give out his time very handsomely and is always willing to help and answer any questions. So thank you for that, Jeremy. Very much appreciated.
Yeah, no problem.
And thank you very much. This has been an amazing interview. I'm sure our audience is going to have a lot of questions, but we learned a lot today from you. So thank you for that.
Yeah, thanks for having me on. Good luck to everybody. I know it's very odd, interesting times. Just be very careful out there right now.
Indeed.